$40 trillion. That is the number the running total of United States debt crossed for the first time today, 5 minutes after the closing bell. And it explains almost everything the stock market would not tell you on its own. The dollar sank to its weakest in 3 months. Gold climbed about 4%, up through $4,500. Bitcoin jumped roughly 7%, back over 68,000 for the first time since March. Those markets priced a wall of liquidity today. Stocks barely reached for it. The SPX added 0.2%, and the Nasdaq actually finished lower. From the AlgoIndex desk, this is your market close for Wednesday, the 19th of August. Hold on to one thing. The reading that reframes this calm close is the protection that quietly went defensive underneath it. Here are the closing numbers. The broad index settled at 7,708, up 0.2%. Its first green close after 4 sessions of grinding lower. The Nasdaq 100 slipped 0.2% to a 1.5-week low. The fear gauge dropped more than 6% to just under 15. The entire day fit inside a range of barely 0.5%. Set that beside what gold and the dollar did, and the mismatch is the whole point. On the screen, a calm, slightly green session. Underneath it, one of the loudest liquidity days of the summer, running through everything except stocks. So what actually moved today, and why did equities get so little of it? Start before the open. At 8:31 this morning, the Treasury said it would auction more debt at the long end and buy back more of its older, long-dated paper, at least $4 billion of it. Yields eased about 5 basis points, and the assets most sensitive to liquidity took off. The dollar fell nearly 0.9% to a 3-month low. Gold ran about 4% higher, above 4,500. Bitcoin added roughly 7%. At 4:05, federal debt ticked past $40 trillion for the first time. Rising gold, rising crypto, and a sinking dollar on that day is a market marking down the value of money, not marking up growth. The SPX took a sliver of it. The Nasdaq went the other way. Inside the index, chips fell about 2%, while healthcare and biotech leapt 4 and 6%. One vaccine maker rose 177% on a cancer trial result. A 0.2 close, built from a +6 and a -2, is a violent rotation that happened to net to nothing. Here is the part the closing prices left out. Beneath that calm, hedging on the index itself turned defensive today, and it changed character while doing it. Cumulative index hedging finished around -$7 billion into the close. The size is not the story. The makeup is. The last 2 days had been short-dated churn. Today it became longer-dated, puts bought further out, and calls sold further out. That is deliberate, patient protection, not a one-session flinch. Yet, on the same afternoon, the biggest single names drew about $2 billion in longer-dated calls, with one electric vehicle maker alone worth roughly $1.3 billion. Institutions hedged the market and stayed long the companies inside it. Cautious on the index, still leaning bullish on the leaders. It is the cleanest read of the day, and none of it appears in a price that closed 0.2 higher. To the map. And tonight, it is a structure, not a replay. We had no 5-minute bars to walk, so these are the lines that matter, not a path. One number sits above all of them, 7,720. That is the level where dealer hedging stops cushioning moves and starts letting them run. The index closed about 12 points under it, and the evening session pushed right back up onto it. Above it, the first shelf is 7,742 to 7,753. Below the close, demand runs from 7,692 down to 7,676. Firm support sits at the dealer flip at 7,647, 61 points down. Lose that, and the environment turns from mean reverting to trending. The options market frames a one-day band from roughly 7,672 to 7,776. Now the desk result, put in front of you the same as always. 4 looks today, and the split matched the day. The morning was pivot shop. 2 long attempts scratched at the line, and a breakout entry closed at break-even after it stacked on top of an automated signal already pointing the same way. That was a correction, made in the moment, instead of letting the two ride together. The afternoon paid. As the market rolled off the pivot, 2 downside breaks came in, and both were banked as small wins. The book closed flat, and nothing rode into tomorrow. On a pin day before expiration, the job was to work with the dampening environment, not force a direction through it. Looking to Thursday, the bias is neutral, tilting mildly constructive, and it hangs on 7,720. Hold above it, and the drift is towards 7,742 and 7,753 into Friday's monthly expiration. One thing before we close. The free AlgoIndex journal stamps your entry to the live price at that instant, so your fills get judged by the market and not by memory. It is free at members.algoindex.com/auth/signup. The gamma level scorecard and the written version of tonight are linked on the card beside me. That is the close for Wednesday. The 40 trillion print is behind us now. Whether tomorrow's claims number lets the easing story keep running is the question the morning answers. I will be back after Thursday's bell.